In today's episode, I'll talk about two stories. In the first one, I'll talk about how India's electric scooter race is heating up now and why Ather pulled off ahead of Ola for the first time ever. And in the second story of the day, I'll talk about how India's biggest life insurers are playing completely different games and why what they sell matters more than how much they sell. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Wednesday, the 4th of June. See, we are in the middle of something really big right now. Quietly, almost without most people noticing, India has become the second largest market in the world for electric two-wheelers. And yet, we are just getting started in a manner of speaking. Now, this is not just a story about scooters, it's about how a brand new industry is being built right from scratch. It is a space where business, government, technology, and everyday consumer behavior are all sort of coming together to shape what might one day become a multi-billion-dollar market. Now, at the very center of all of this are two companies, Ola Electric and Ather Energy. One came in like a rocket, promising speed and scale, while the other actually took a slightly slower and a more measured approach, trying to build a business brick by brick. And over the last quarter, January to March 2025, something very interesting has happened. The roles have actually begun to reverse. But before I move ahead, let's first take a quick step back and understand how electric scooters suddenly became such a big deal in India. See, back in 2020, almost nobody bought them. But today, over 1 million electric two-wheelers are being sold every single year. Now, that did not happen because people suddenly became more eco-conscious. The real driver was actually money. See, with fuel prices staying high and electric vehicles having much lower running costs, more and more Indians suddenly started doing the math and going electric as a result of it. But that said, this is still a small slice of India's massive two-wheeler market. Every year, we sell nearly 20 million two-wheelers in total, but only 1.2 million of those were electric in the year 2024. That, mind you, is just 8% of the market. And within that segment as well, scooters have done relatively better by capturing about 15% of the segment, but motorcycles are still lagging behind at under 5%. So opportunity-wise, there is a huge margin over here, and companies are definitely racing to claim it. Now, 4 major players have taken the lead so far: Ola Electric, TVS, Bajaj, and Ather. And together, these 4 make up over 80% of the market. Now, out of these as well, TVS and Bajaj are old players. These are traditional ones who have used their massive dealership networks to very quickly establish dominance in this new space. TVS iQube, for instance, has been India's best-selling electric two-wheeler in recent months. Bajaj's electric Chetak is also catching up quickly. But today, I'll not be looking at the old players. What I will be zooming on are two tech-first players, Ather and Ola Electric. And that is because unlike legacy automakers, these specific companies did not really set out to make a scooter. They are trying to build a whole new user experience, right from software to charging infrastructure and to scale like a startup. Now, here is where things get a little bit interesting. See, for the first few years, a big reason EVs could compete with petrol vehicles was government subsidies. The FAME scheme made EVs much more affordable, both for buyers as well as for sellers. And on top of that, some state governments offered their own extra incentives as well. And that created a very supportive environment overall. Companies, as a result, could sell aggressively priced products, build scale quickly, and also establish their brand without really bleeding cash on every single sale. But all of that changed in 2024. The FAME 2 scheme was wound down, and in replacement, the government introduced a short-term electric mobility promotion scheme, which was then replaced by the PM eDrive scheme. The subsidies were lower, and most of the incentives actually shifted away from two-wheelers towards bigger vehicles like buses and trucks. Now, for electric scooter makers, this was a massive blow. Prices rose overnight, and companies had to either absorb the cost or they had to pass it on to their consumers. It was not just confusing, it was also very expensive. Now, that is the backdrop for the Q4 2025 results, and the numbers tell a very clear story here. Let me start with Ather very quickly. See, they had a solid quarter. Revenues went up by 29% to 676 crore rupees. Unit sales went up as well. They sold over 47,000 scooters, which is a 34% jump from last year. Now, they are not still profitable, but they have made big progress here. Their operating losses came down by 17% from 283 crore rupees to 234 crore rupees. And more importantly, they have now become much more efficient. Their operating margin, which is by the way a measure of how much they lose per rupee of revenue has improved from minus 45.6% to minus 25.5%. Now that, mind you, is a big improvement in just 1 year. Anyway, now let's move on and take a look at Ola Electric. Their quarter went in the exact opposite direction. Their revenue collapsed from 1,598 crore rupees last year to just 611 crore rupees this year. Now that is a 62% drop. But despite this, their expenses stayed high. It was over 1,300 crore rupees, which means that they were losing money hand over fist. Their operating margin fell to minus 114%, which in other words means that for every rupee that they earned, they lost more than 1 rupee. And their net losses effectively doubled to 870 crore rupees. Now to understand exactly how shocking this is, consider this: not too long ago, Ola Electric was outselling the next 3 players put together. They almost looked unbeatable. But for the first time ever, Ather's revenue actually overtook Ola's. So the question is, what really went wrong? The short answer is registrations. See, in February 2025, Ola had a massive operational failure. Due to contract issues with the third-party firms that handle vehicle registrations, thousands of Ola scooters could not be registered on the Vahan portal. Customers had received their scooters, but they could not legally ride them. And this was not just a blip, mind you. It completely derailed their quarter. And while the company says that this was temporary and they project higher revenues next quarter, the damage, to be very honest, has sort of already been done. But beyond this, the story goes even deeper. See, these two companies have always had very different philosophies. You can take product strategy, for example. Ather, for example, focused on just 2 product lines, the 450 series and the more affordable Rizza. Now, Rizza has very quickly become their best seller and makes up to 57% of all their sales. But Ola, on the other hand, went very wide and they had a long list of models and variants at various different price points. They even launched an electric motorcycle, which is the first of its kind from an Indian electric vehicle company. And it's not just that, you can also think about how manufacturing works here. See, Ather is building up slowly. It recently expanded its capacity to 4 lakh units a year by adding a second facility in Hosur. Ather basically funds its growth very carefully, even using its IPO to raise capital instead of taking on debt. But Ola again is doing exactly the opposite. They are building big from the very start. Its future factory is designed for 2 million units annually, and it is also trying to build its own battery cells, which could be a major advantage, but the project is currently delayed. Then there is their market approach as well. See, Ather began targeting premium users in South India, and they've honestly done pretty well there. They have a 22.4% market share in that region. But the problem is that their reach is limited. They don't really have strong financing options for smaller towns, and their presence outside the south part of India is relatively weaker. But Ola, in contrast, went nationwide from day one. They expanded into metro cities and smaller towns together, and this helped them scale fast, but it also meant that they had higher operational complexity. Their new electric motorbike, for instance, is likely to do well in regions where Ather is not even present. Anyway, if you move on and look at retail here, the difference becomes even more strong. See, Ather grew from 208 to 351 experience centers last year, and Ola, in the exact same time period, went from mostly online sales to over 4,000 physical sales and service points. Now, that is one of the fastest retail expansions that has ever been seen in Indian automotive history. Now, charging infrastructure is another space here. Ather has built over 3,600 fast charging points under its Ather Grid banner. But Ola, on the other hand, has a smaller but a growing network with nearly 1,300 charging points split between its fast charging hypercharger network and regular chargers. Now, both also offer home charging options, by the way. Now, I know some of you might be wondering, why does charging even matter if you can use any network? See, technically you can, but the companies optimize their chargers for their own vehicles, which means faster charging, better app integration, and a smoother experience. And more importantly, the chargers also collect data. Owning this infrastructure basically means owning the customer's relationship and possibly even the platform. And that is a huge advantage for companies. Anyway, finally, there is also software. See, Ather now sells a subscription-based Pro Pack that gives customers access to features like navigation and ride analytics. It works like Netflix of sorts, recurring payments for premium features, and 88% of their customers have signed up for this, and it now accounts for over 6% of their revenue. On the other hand, Ola has actually followed with their own software upgrades, but they charge a one-time fee instead. But still, it's very clear that both companies are betting big on software-based monetization. So then the question is, what really happens next? See, at this stage, there is definitely no clear winner. Both these companies are still growing in their own ways, and both are still unprofitable. And both are also exploring international market. For example, Ather has entered Sri Lanka, while Ola is looking at Latin America and Africa. But what is clear is that India's electric scooter market is no longer just about early adopters. The industry is now growing up, and companies building it are being tested not just on vision, but on execution. On that note, let's move on and talk about the second story of the day. See, India's life insurance companies have had a mixed performance in the fourth quarter of FY 2025. And when you say something like that, it usually means that some players did well, some did not, and the reasons behind those outcomes are not very straightforward. And that is exactly what the case is here. See, at first, when you look at the headline numbers, which is how much new business each insurer did and how much profit they earned from it, you will see four very different stories. These are in the four biggest names of the space: LIC, HDFC Life, SBI Life, and ICICI Prudential. So to understand their performance, let's first talk about two terms that are widely used in the insurance world because this is important for this story. The first is APE, or annual premium equivalent. Now this is a standardized way of measuring how much new insurance business a company sold in the quarter. The second term is VNB, or value of new business, and this tells us how much profit the insurer earned from the new policies that it sold. Now here is what happened the last quarter. LIC saw a decline in both their sales and profits. HDFC Life managed to grow sales and held steady on profitability. SBI Life grew sales only slightly, but they pulled off a major jump in profits, and ICICI Prudential actually saw sales fall but still increased profits from their new businesses. Now this performance was not uniform like you may have figured. Each insurer played a very different game, and the real story therefore lies in what they were selling. See, most people think of life insurance as one simple product, but in reality, life insurers sell a wide range of policy types, and each type actually behaves very differently when it comes to profit. It's not like regular business where selling more units means making more money. In life insurance, two companies can sell the exact same amount of policies in terms of premium value, but one can actually be making a lot more money depending on what kind of policies that it has sold. And that is because not every rupee of premium is equally profitable. I'll break that down for you. See, life insurance works like this. You pay the insurer a premium, and in return, they promise you a certain benefit. It could be either a payout in case something happens to you or a lump sum at the end of a particular period. And until that particular money is due, the insurer gets to hold your premium and invest it usually in bonds, stocks, and other assets. Now that of course generates investment income, and the company earns interest, dividend, and capital gains on your money. But they also have to pay you back as they had promised. So the profit that they make really depends on the gap between what they earn from investing your money and what they owe you. And that is where different types of policies actually come into the picture. See, some products are safer and more profitable for insurers. The others, on the other hand, are riskier, more complex, and they have thinner margins. So what really drives profitability here is the product mix, which is the proportion of each type of policy that is being sold. And to make this easier for all of us to understand, let's imagine placing all life insurance products on a simple 2x2 chart. On one side, we ask, does the policy holder share the insurer's profits? If yes, it is called a participating or a par policy. But if not, it is a non-participating policy. But on the other hand, we ask, are the returns fixed and guaranteed, or are they linked to the performance of the market? Now let's walk through the four boxes that this creates. First, participating and guaranteed policies. Now these are traditional savings-oriented policies. They offer guaranteed benefits plus some bonus depending on how well the insurer does. But there is a catch here. Insurers have to share 90% of the surplus profits with policyholders. Only 10% actually goes to shareholders. So while they are stable, they are not very profitable for the company. Second, non-participating but guaranteed. Now these are very popular nowadays because they offer fixed benefit plans where the insurer promises a return and they keep all the profits from smart investing. These include things like guaranteed savings plans, term insurance, and annuities. And since the insurer does not share the gains, this is where they earn the best margins. But they also carry investment risk. If markets do not perform well, the insurer still has to honor the guaranteed payout. The third one is non-participating and market linked. Now this is where ULIPs or unit linked insurance plans sit. Here the policyholder chooses their investment, bears the market risk, and the insurer just takes a fee. Now ULIPs are great for boosting sales in a bull market, but the margins here are very low. The insurer is basically acting like an administrator, not really as a profit maker. The fourth box is participating and market linked. Now this is rare and does not really have many real world examples, so we can possibly ignore it for now. Now once you understand all of these product types, the rest of the picture starts to make a lot more sense. Let's take SBI Life for an example. See, they didn't grow sales too much, but they made a smart pivot. They focused more on high margin, non-participating guaranteed products, and that helped them convert flat sales into a strong rise in profits. Their VNB VNB margin hit 30.5%, which is among the highest in the industry. Now contrast that with what LIC does. See, LIC has traditionally sold a lot of participating products which are safe, conservative, but have lower margin. Around 72% of its new business still comes from these. And that is why, despite being the biggest player in the industry, LIC's margins are far lower at just around 18.7%. Now, they have been trying to change this by selling more term and non-par savings products, and margins have improved a bit, but the shift here is obviously very slow. Anyway, HDFC Life is somewhere in the middle of all of this. They have taken a bit of a balanced approach where they're selling a healthy mix across different categories. Some par, some non-par, some ULIPs, and some protection. And this diversification has helped them grow consistently without really putting on too much risk on any one product type. And that is what makes their growth also look steady and reliable. Anyway, moving on, ICICI Prudential is a more complicated story. They were once known for being ULIP heavy, and that gave them strong sales when the market was booming. But their profitability took a hit as a result. In FY 2024, ULIPs made up 43% of their new business. Now that is a lot, and you can see the impact. Their VNB margin dropped from over 32% to just under 25%. Now they are trying to move away from ULIPs, and they are wanting to focus more on guaranteed non-par products to fix their margins. The results are starting to show as well, but it is a gradual transition. So what all of this sort of tells us is that the insurance business is not just about how much you sell, it is also about what you sell. Product strategy matters a lot over here. A company that sells fewer but higher margin products can sometimes end up doing much better than the one that chases volume in low margin areas. And this quarter made that very clear. The differences in profit margins, the shift in strategy, improvements and challenges each insurer faced, they all sort of come down to the same thing, which is the product mix. And that brings me to the end of the two stories of the day. With that, let's move on to the final section and talk about the quick news headlines. First, Maruti Suzuki recently said that there is no immediate production impact from China's export curbs on rare earth magnets, but they acknowledged ongoing discussions with the government over the issue. Now, for your context, rare earth magnets are a critical component that are used in electric vehicles and other automobile systems. China, which controls over 90% of global processing capacity for these magnets, recently imposed stricter export regulations, including mandatory import permits and end-use declarations. Second, GAIL India Limited has issued a prompt tender to resell a liquefied natural gas or LNG cargo already en route to India, as lower than expected temperatures and ample inventories reduced domestic demand. The cargo was loaded on May 10th and was scheduled to arrive on June 11th, but the vessel made a U-turn near Reunion Island on Monday according to Bloomberg ship tracking data, and is now being offered to buyers in Europe or the Middle East. Third and the final one for the day, NMDC reported a sharp rise in iron ore production and sales for May 2025, producing 4.43 million tons of iron ore, up 89% from 2.34 million tons in May last year. Sales also increased by 54% year over year to 4.34 million tons compared to 2.82 million tons in May 2024. That's all the news and stories I have for you today. I hope you enjoyed the show. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.